Good morning, traders. This is Christian from Hertz, Tribeca Trade Group, and it is Sunday, February 2nd, Super Bowl Sunday. Looking forward to a great game. So, what I'm going to do with this video, guys, is there will be two videos. There will be this one video. I'm going to just talk very high level, and we'll go over some of the indices. We'll go over the sectors and so forth, kind of what we're seeing in the price action. And then, of course, what I'm going to talk about is the impacts of the coronavirus and how we're going to deal with this week. And, some of my thoughts, really. And then the second video will be more on some single stocks to watch. And I'll get into that in the second video. But I wanted to keep things pretty clear and concise and kind of formulate a game plan for this week. So first things first, this is the risk disclaimer. Of course, everything that we're going over is for information purposes, not giving out any advice or recommendations. And so let's start with a couple things. Right. So number one, I've had the earnings season bullet point on the top of the video for the last couple weeks, right? So now we've already had a number of companies that have reported. We're still going to get more like Google's after the close on Monday. But it's playing out and pretty true to form in regard to difficulty to swing trade, right? So this is all things that I've talked about for the last couple weeks. Now, of course, there's been a whole bunch of other developments like the virus that have made things much more complicated. But remember this for going forward, that earnings season, lighten up your risks going into earnings season, in my opinion. That is something that is, for me, has worked over and over and over every quarter. It is not the place to take a lot of risk, and I think if you look back in the last couple weeks, you kind of realize how difficult things have been. The way a name reports earnings, and sometimes they go up, sometimes they go down. One company, like for example, I was looking at on Friday. Now, of course, a lot of things happening on Friday. But look at this, for example, look at Edward Life Sciences. They come out and they report good earnings. I have to read through their full quarter, but this is why it's very tricky. The name starts up like 4 or 5% and finishes down 6%. So there's a lot going on. There's a lot going on, and unless you're like listening to every one of these conference calls and staying glued to it, there's a lot of tricky moves. So my, thought is always to lessen risk going into this. It's very tricky. So that worked for me. I hope it worked for some of you. But I gave those thoughts in the last this video, and then last week's, and then the week before that, so a couple weeks. So I'm going to talk about the coronavirus in just a second. Let's talk a little bit about, because with any one of these events that we have that are kind of disturbing the markets, there's things to watch technically, and some people, of course, will just watch, pure technical analysis will watch less and less news, and they'll just watch price action as well as the internals, as well as some indicators that are going on. So what, what is market breadth basically telling us? So if we pull up the advanced decline line, for NYSE stocks, by the way, this is not for NASDAQ, this is for NYSE, but we definitely have a pullback here, right, in market breadth. I mean, I think from, if you have the luxury of being in the trading room during the day, or, mostly being a full-time trader or a part-time trader, and you spend some time in the room, one of the things that we've been looking at every day is market breadth, right? We have an indicator for that, just to kind of tell you about selling pressure, buy pressure. And, every day, except for I think Tuesday, which was pretty constant to the upside, market breadth was really heavy to the downside. And now you can kind of see, from what we were watching on a day-to-day basis, you could see that this advanced decline line has broken below the 50-day moving average, right? So that hasn't happened. It happened a little bit here and a little bit there, but it's basically telling you that more things are declining than advancing. That is confirming basically what is happening in the indices right now, right? So there's no, what we like to spot is when things are confirming, or when, on the opposite, when things are, looking for divergences when things are diverging. So right now everything's kind of confirming one thing or another, right? The S&P, which again is going to be dominated by your bigger companies because it's market cap weighted, is still holding the 50-day moving average. But if you look at things like the RSP, right, which is basically taking those same 500 components that are in the S&P but equally weighting them versus having them market cap weighted, you could see there's a bigger breakdown going on underneath the surface, right? You've got not only a break of the 50-day moving average, but you got a pretty decent break. And we're going to be starting the month below value for the major components, right? So again, sometimes when you're looking at an index that's market cap weighted and you have a couple names that are really dominating the index, it can mask things a bit. So that's why I'll look at some equally weighted indices to kind of give you a clearer picture on what is going on with the overall market. So you've got more of a steep breakdown when you factor in, when you make Apple and Microsoft and Amazon the same weight as some of the smaller components that are in the SPY. The Qs, we can look at these as well. Same thing. I think I'm trying to think of the equally weighted Qs, but I can't think of it right this moment. But you'll also see a similar thing that's going on here. The Qs right now are just below the 20-day moving average, but if you bring up the equally weighted version, you'll see that I want to say it's QTEC, but that may not be it. Is it QTEC? Sorry, I don't want to be doing the research while I'm doing the video. But let's see if this is it. Shields of the Nasdaq fund. No, I don't think that's the right one. So anyway, I will look for it, and if I find it, I'll post it. But I think what we're seeing is under the hood, we're seeing more stocks break down. You could certainly see that with the small caps as well. The small caps have not only broken the short-term moving averages, but they've broken the 50-day moving average, and it's done it decisively, right? Also, the thing to note is the volume. The volume. Remember how volume works. I know there's a lot of misconceptions about volume, but when the market turns, there's big volume, and especially on declines, there's often big volume. There's not on increases, right? Again, just to point this out really quick, which I don't want to go too far off the beaten path here, but very low volume usually when we're grinding higher, but big volume on turns, right? You could see that in S&P futures. Okay, so that's kind of showing us a breakdown all over the place, and the internals are confirming that as well, with the advanced decline line breaking down. Go back to some of the bullet points. So right now, that's confirming what we're seeing. We're not seeing any divergence yet. It's too early for that. Sentiment, what's happening here? Well, the City Panic Euphoria model, if you've been a member, you know that we talked about this hitting euphoria 2 weeks ago. I had it's funny because the conversations that I'm having with people on Twitter, it's interesting to say the least. But someone went out and told me, and they said, "Oh, well, this model is kind of flawed. It's slow to adjust." And I said, "Okay, that's fine. They only put this market sentiment model out by Citigroup. It only comes out once a week. It comes out in Barron's, as far as I know. Is it a little bit slow to adjust? It could be. It's still ticking at euphoria. But really, the signal for me and how I use this is when it gets to extremes. So we know that it got to an extreme 2 weeks ago. That was the point to say, lighten up on risk. I did that. So and I talked about that in the last couple in the last weekend videos. Now what is it saying? It's still ticking up at euphoria, but again, for me, how I use this thing is when it gets to the extremes. That's when the model to me is actionable. When it's kind of doing everything else, it's not firing off like a meaningful signal, at least to me. And again, that's how I've used it. We went through in previous videos as well. The last time that this thing hit euphoria, the market was bad for basically a month. The last time that happened. Now, I don't know if that's going to be the case this time, but again, using that to your advantage and saying, hey, When this thing hits euphoria, lighten up. And I can't go back 2 weeks ago and say the same thing to you, but that's what we went over in those videos. The fear and greed index. So it's at a 44. So let's bring this thing up. My opinion on the fear and greed index is, is it useful? Probably a little bit, just to see where sentiment is, but it doesn't really give you any wonderful signals, in my opinion, right? Maybe because sometimes it can stick at, and I think it's stuck at around extreme greed for weeks. That's not a signal. When something's at extreme greed for weeks, where's your signal? In the beginning? When in the end? I don't know. And if you would have taken off risk the first time that it hit extreme greed, you would have missed out on profits, right? Because the market still went up for a couple weeks after that. So that to me, this is not such a great indicator of something shows you extreme greed and the market still goes up for weeks and months. That's not a great signal. However, we can kind of we could take this with a grain of salt and say, well, it's definitely, now ticking to fear, but I don't know if that's not, just because it's at 44, what I'm trying to say is I don't think that's a buy signal just because it's less than it was. This thing can go a lot lower. And what does it measure? The other thing is take a look at what it measures. Well, it's got the VIX in here. So you could basically, I think, just look at the VIX and some of the things like the put call ratio. These are not, like, to me, anything that I don't know already, right? The new 52-week highs versus lows. Sure, these are important things, but you could look at these things in isolation and make the same conclusion right now. All right, so that's where that's at. Some people like to look at as well the fear and greed over time, but so yeah, it's worth looking at. I just don't know if there's any major decisions that you can make, based on it, because things can this model can be a little bit sticky with things staying in the same range for a while. But it is what it is. It's way off the highs. All right. So again, I try to give you my interpretation of how you can use some of these things, and you could argue with me and think different. That's fine. If it works for you and you could profit from it, that's all that counts. So the put call ratio, that was something that I also wanted to look at. That is ticking up higher. That's whenever we have a pullback, no matter what it is. One of the things that I like to see is that fear kind of come into the market where people are really loading up on puts, right? Sometimes you could, and I do use this as a contrarian indicator, right? When everybody is starting to freak out, that's usually one of the boxes that has to be checked. People need to freak out a little bit, and then buyers can kind of come back in and take advantage of the people who with the knee-jerk reaction are buying puts, maybe not exactly when they should be, right? Sometimes people buy puts when it's too late, or when the move has already taken place. So that's also something that I think is a good thing, that we've now got some fear into the market, and removing some complacency from the market. All right, so now here comes the big one, the coronavirus. How do we handle this thing? Well, there's two things not I won't say two things. There's more than two things, but I think there's a couple key things, right? I would listen to the White House briefing that was on Friday. That came in. Remember, that was at 3:30 on Friday, and I'm in the middle of trading. I'm in the middle of trying to post option activity for you. Get my book tidy for the weekend. So I was listening to it, but I went ahead and just re-listened to it this weekend, and I posted that. There's a YouTube video of the whole White House briefing, and they had the CDC there. And I think it's important to listen to this versus listening to every little tidbit on Twitter. My takeaways from listening, with any one of these outbreaks, right? We've had them in the past, right? There's been other cases. There's been, what the Ebola. There's before that. There's been various different type of outbreaks. So this is not completely new, right? I mean, every one of these is unique, but you have to understand this is still in terms of like it's still pretty fresh, right? That from when this has started to happen, it's only a couple weeks old. Keep in mind, research, scientists, they can't just come up with a conclusion right away. That's just not how it works, right? I have a lot of faith in scientists and the health community, but you have to give them a chance to kind of do their work. They need time to analyze. This is spelled wrong. Research and make conclusions. So if you listen to what they were saying with that briefing, it's still in the infancy stages. It's too new for them to make any major conclusions. And again, just listening to you don't have to listen to like the whole 30 or 40 minutes. Listen to the first 5 or 10 minutes of it. They need to do their research. And until that happens, until they have a handle on what this thing is, they're taking precautions, right? They're not allowing travel to China. They're Apple is closing for a week. That's, in my opinion, that's smart. Why would you stay open if you don't know what is going on? Why would you continue to have travel to China if you don't have a handle on exactly what the level of this is? Let's say, to the flu. So these are smart things, and realize that these guys, they cannot, within 48 hours of an outbreak, they can't come out and say that they understand this thing fully. Now, it's been a couple weeks, but give the scientists a chance to do their work without everybody freaking out on Twitter. And let all these places, China, do what they need to do to try to get the situation under control. And then the scientists are going to come out and, I think, give us more of a picture. But they don't, again, they're human. They're human scientists. They need to do their work and not come out with irrational conclusions. So that just takes time. So could it get a lot worse before it gets better? It could. But I'm being slightly optimistic that we have better technology than we have now than previously. We heard on Friday that there's a couple companies that are already, trying to tackle the situation with trying to come up with, a medical solution. Now that may take months before they can develop it, but right, they're working on it, and they've come out with previous solutions to these things. So it is what it is. I think you just have to kind of let this play out and try to keep a level head as this is going on. Did I cover everything I wanted to? I think so. I think so here. But I think, again, bottom line is that they're making all these precautions, which I think is smart to do until they know more about it, right? Until they know everything about it. Company impact, right? This is an impact to revenue, profits. If a company has to shut down operations for a week, a couple weeks, a month, right? That's an impact to revenue and profits. It's an impact to their bottom line. However, if it's only just that, and again, we don't know if it's, that's why I say a week or a couple weeks or a month, because we don't know yet. But if it ends up being that in the realm of that short term, then it's recoverable, right? You'll have a knee-jerk reaction to in what we're seeing right now in equities. As companies shut down, stock prices are going to go lower because it's an impact of revenue and profits. There's no doubt about that. You can't shut down and have the same revenue as you were expected to. So that goes hand in hand. So yeah, we'll just have to see if this is short term or if this is going to be a longer term situation. Where was there? I had something else in here too. Oh, okay. So I have also, I thought this was also very interesting. Kramer's down at the Super Bowl, and he managed to get in front of, I guess, Tepper. This is on my regular Twitter page, so you can view this. It was a quick, like, 2-minute interview, but Kramer said, like, to Tepper, "Hey, you were on CNBC a couple weeks ago. Now it's a little bit of a different picture. Do you think this is a game changer?" Well, first of all, Tepper doesn't really, he's a smart guy, no doubt about it. He's got an amazing track record. But just as we're going through this and listening to that White House briefing, he doesn't know either. Could it be a game? So when somebody asks you, could it be a game changer? Well, sure, it could be a game changer. We don't know yet. We just don't. So going back to so I think that's important because I put this out. I retweeted it, and of course, like a whole bunch of people were making comments, and they're like, "See, Tepper's, he's selling." Well, he doesn't know. He doesn't know either. He doesn't have a crystal ball. He's smart. He's got an amazing track record. He's got good instincts, but he doesn't know either what the extent of this is going to be. So, he's probably thinking the way I'm thinking. I would hope. Control what you can control right now. Your risk. I would not, be exposed right now to a lot of short-term options and things like heavy short-term options. You can only can control what you can control, and that's basically how much money you're putting into the market right now. And especially, there's something to be said for thinking about things short-term or long-term and how that's positioned. So the other thing I have in here is, be careful with Twitter, which I think I've already said. Sometimes Twitter can be more dangerous than the actual reality, right? There's a lot of people on Twitter who have been permabulls, and they're using this to exploit fear. So be mindful of that. It's crazy, but that's what these guys do. They look for anything to try to make the situation worse than it may seem. Okay, so let's get away from that for a minute and let's talk about what we can do, right? Well, we can make adjustments. Again, some things that I've been talking about for the last couple weeks: trading options versus stock. The situation is with if you have a pullback that lasts more than a couple days, if you're trading short-term options, meaning a week, 2 weeks out, or even monthlies, right? And if this doesn't straighten itself out in a very short amount of time, you could lose the whole investment on the option, right? So you could be right. So let's say, for example, you like Salesforce or the S&P. It doesn't even matter. But I think it's good to go through one of these scenarios because I've been through these. We've certainly have seen and have traded through many pullbacks, some longer than others. But let's say this. By the way, Salesforce it will be on the watch list this week. But let's say maybe this is a bad example. Let's look at let's look at Apple. Right. So Apple was down 4.4%. And you're thinking, hey, this may be a good dip to buy. I'm going to go into next week's calls. Now, if you do that, and this thing, let's say that you did that at the end of the day on Friday. You went into next week's calls, right? Let's say this thing opens up down 2 or 3%, comes back in, maybe it comes back in here to the top of January's value area, which, by the way, we're going to be in February. We are in February. But let's say it does that. Let's say it checks back. And the options that you bought are way underwater, and they expire on Friday, and it takes some time. Eventually, it moves its way back up. But let's say that happens in 2 or 3 weeks. Those options that you bought are expired, so you lost the full premium on it, and Apple could be right back to where it was. So you have to kind of think about things like that. The time frame of when this could happen can recover. And again, I don't know when it's going to recover. It's too soon to think about when things will recover. But if you're not giving yourself enough time on the trades, you're shooting yourself in the foot from the very start. Now, if you want to take a shot on next week's calls, do it with the money that you're okay with losing. That's the way you should be thinking about it, in my opinion. Is if you're spending $1.50 on a call for next week, have the understanding that you may lose the whole $150, right? Now, if something happens and the market goes up, that could be a winning trade. But I would only be putting in with options, as I say many, many times, only put in what you are willing to lose. What else? Also, so I want to talk about this as well. And the other thing that I've been doing is I've been trading more stock because the VIX is higher than it normally is. It's close to it finished close to a 19. To me, that makes option trading much more difficult. A little bit less difficult if you're day trading, uh, because you could get out of these things very quickly. But if you're swing trading, if the VIX is at 19 and let's say that this is a short-term phenomenon and the VIX goes back down to 14, those options that you bought with the VIX at 19 by default at a 14, when the VIX goes down to a 14, it means that that's going to be the price of the holding all things equal. The value of the option is going to go down because the volatility isn't the same. Remember, if you're not familiar with option pricing, like the Black-Scholes model, maybe something that you don't have to learn like how to calculate the option price from Black-Scholes, but at least understand the components of what goes into the options, right? So that's why I kind of switched to stock a little bit. You're dealing with a lot less variables that are moving around when some of the things like the VIX is going all over the place. Now, of course, you still have to stick if you're trading stock like I was doing last week. You still have to define, in my opinion, your risk and your stop price, because it's just like anything else, right? Obviously, it's a bigger investment when I use stock versus options, and I want to make sure that I've got my stops in place when I do that. But these are the adjustments that, whether or not you're moving to options to stock like me, but I think other adjustments you should be thinking about, like the size of if you are still trading options, the size of the options, right? You don't need the same amount of size when the VIX is at 19 versus when it was at 13, right? So there's definitely some things to think about as the VIX has changed and as the market is moving faster as well. Again, that's a mistake. The reason why I bring this stuff up is because when I first started trading options and I was trading the same position size no matter what the market was doing, and I was noticing a bigger difference fluctuation in my P&L because of because I wasn't taking into account the sorry, I wasn't taking into account the sorry, I'm getting distracted with something. I wasn't taking into account how the volatility was moving, right? So again, I tell you these things, and I give you some of my experiences so that you don't make the same mistakes that I've previously made in my years of experience. Okay, so let's move on from that. And again, if you're not understanding anything that I'm talking about, feel free to private message me in Slack, and I'm happy to go into more detail and to kind of help you out. All right, watch support and internals. These are some of the things that we've already talked about. Making sure that you're defining your stop price as well. So I'm going to go into. I just want to cover the rest of these bullets, but I'm going to go into the. So I already talked about the indices. Um, I'm going to talk about a little bit of support in the S&P, and then I'm going to talk about some sectors. Next, I wanted to make sure like a couple other things. Tonight's the Super Bowl, guys. Have fun. Watch the Super Bowl tonight. Don't get caught up too much in like watching the futures and so forth. Tomorrow could look a lot different than where we opened tonight. So, don't let that like mess you up like mentally. Also, another thing is China has been closed for a week. people are going to come out and on Twitter, they're not going to fully understand what's going on. So, what I mean by that is while China has been closed, and I'll bring this up for you very quickly, right? So, this market, right? The Hang Seng has been open. So let's look at the two differences so that you can kind of get some idea of what's happening here. But the Hang Seng, right, which is Hong Kong shares, right? They were closed for a couple days. They were open. They were down 2.8%, 2.6. They were down again Thursday night going into Friday, down a half a percent. The market that's been so again they were closed for a couple days, but the market that everybody is going to be looking at is this one, which is the Shanghai. And if we look, the Shanghai has been closed. Let me see if I did this right. It's been closed since what? The why is this not coming up the way I wanted to see it? Yeah, so since the 24th, right? So we have no data on that. All right, so this has been evolving now for a week. So what do you think is going to happen once this market reopens? Well, we kind of know a little bit what's going to happen. There's been no data since the 23rd, right? So that's over a week. But if we look at there has been some things that have been trading. So this ASHR, this is the ETF for local Shanghai shares. Now let's put in since they've been closed, and I think that they've been closed since the 23rd. I may be off with a day with this, but I'm just going to put in the 23rd, and we want 2020. So what is the difference here? So if we go to the right, it's down 8.9%. So again, it's assuming what the price of Shanghai equities are, even though the indice is closed. There's also futures that trade on the local Chinese shares as well, right? So they've been trading even though China's been closed. So what is this already? So it's already adjusted to the news that's been on the tape for the last week. This ETF is down 8.9% over the last week. So when China opens tonight, it has to, being that it's been closed, it has to catch up because it's been closed. So from the information that we have at hand, let's say from Friday, the Shanghai market, the local Chinese market, should open up 8.9% down. That's already what we know. Anything additional to that, right, from what's happened this weekend, and you could see a move, obviously further to that. So keep that in mind because there's going to be people on Twitter tonight saying, "Oh my God, this market's down 8.9%. How much is the U.S. market going to be down?" Well, this is already reflected, right? Because it's been trading. So don't get caught up in that nonsense because people don't understand that on Twitter. They're going to go nuts tonight when they see that China's down 9%. Meanwhile, it's already reflected. Okay, so I'm giving you a little bit of an advantage here. Don't get caught up in the hype. You're going to see it tonight. People are going to freak out when they see, and it could be down more because, there's more information that's come out since Friday. So this thing has the chance to be down more than 10%. But don't get sucked up into the fear because the market already knows that this thing is down 9%. All right. So again, if you don't understand that concept, I'm trying it as best as possible to explain that. It's a kind of a difficult concept to understand, but it is what it is. Trading futures. Let me just give a quick tidbit on this. Even if you've been trading futures for a while, this is going to be more difficult. Just like when we've seen other things like, back when the U.S. election happened, when Brexit happened, when it was like announced, right? It's very tricky. I can tell you, if you haven't traded futures before, this is not the time to start. It's even tricky for somebody who's been doing it for a long time. So just be mindful of that. I don't think now is the time to get involved in that. if you haven't before. Um, okay, so I think that is some of the things. Now, so what I'm going to put together in the second video, and again, you guys don't have to watch both videos, but I wanted to kind of separate the two, because what I'll do with this video is I might send it out publicly at some point, and I don't want to reveal like everything that we're doing or my secret sauce and so forth, but think about like putting together a watch list, and what I'll be doing in the second video, it's more of kind of a wish list. You want to be prepared, even if you're not like ready to buy the dip, and I'm not going to be ready to buy a whole bunch of things on Monday, but I want to start putting a game plan for the stocks that I really want to be in as the situation develops, right? So always in trading and investing, rather than watching every single headline, put the work of like stay calm, because in sometimes these crises really brings out good opportunities. But you have to kind of think about things, and think about things with a level head, and say, these are the groups of this is what I want to go into. Um, let me draw a scenario plan out, but I want to be able to execute rather than say, oh my God, there's another case of this thing. So having a plan and thinking about things a little bit less emotional will put you that far of the game. Will put you that far of everybody who's tweeting out every single case. Those guys are not going to be prepared. They're going to be trading emotionally. What we want to do here is have a level head and be able to execute our trading plan, adapt to it, make adjustments, and be thorough. Just like we've traded every other pullback and situation. We've been there before. I've been there before. And I'm going to use that to my advantage to execute and be efficient with what I'm doing, because I think this will end up being a good opportunity. But you have to be number one in this situation. Be patient. Uh, think about how you're adding risk if you're going to be doing that. And again, sitting back is and waiting for confirmation. That's also what I'm going to be doing a little bit, but I'm going to be taking a few small shots. Not anything large, but I will be looking at some names that are probably just down, and I'll be taking some small shots where I'm dollar cost averaging into it. But all in all, I'm going to have a game plan for confirmation as well, and that's really where I want to be putting um, more money to work once I start to see things like the advanced decline line go back up. Once I see more new highs versus new lows. Right now we're seeing the opposite. So those are some of the things. I want to see the VIX. Like the VIX will start to, once I see it go back below 15. Also right now it's in what's called backwardation, meaning that in futures terminology, the current months, the closer to expiration, maturity months are bid up more than months further out. That's called backwardation. What a normal futures market is in contango, where further maturity months cost more than the nearer term ones. We don't. So that's what I want to see the VIX flip back to, from backwardation to contango. That's when we know that things are changing a bit. So we don't have that yet, but again, putting this checklist together, I think is very important, and that's what we'll be doing this week. And again, I think there will be some great opportunities, but they just not maybe yet. And I talked about this a little bit in the training room on Friday. Some of my past mistakes have been when we get a 3 or 4 day pullback. Sometimes you're buying on that first, second day a little bit too much, so that by the time this thing works its way out, you're underwater too far. Now, if you're taking small shots and it works its way out, those small shots by nature are not going to hurt you that much. You still may be underwater, but you're really being cognizant of what you're doing, right? And what you're risking, All right, so that's kind of the game plan. I'll go through very quickly some sectors here. One of the things that I was looking at is, and I talked about this one also last week. Let's see if I have this up here. This is the semiconductors. The semiconductors were I thought were showing some weakness. This is semiconductors versus the Qs. You could see that the semiconductors are breaking down. This kind of makes some intuitive sense. Two different ways, I would say. Number one, a lot of the chip makers are located in Asia, and they're just going to have a tougher time right now. Also, they're kind of a little bit leading too. If companies are going to be shut for a little bit, the semiconductors are some of the first ones to react to that. Now, if you look at some of the groups that I was playing last week, I was really participating more in software names. Look at the software versus the Qs. Notice it's not exactly opposite of what the SMH semis are doing, but there's some relative strength there. That also to me makes some intuitive sense because they're a little bit, the software companies are a little bit less exposed, I think, to virus. Now, they're still going to have some effect. And when risk hits, some of these software companies are very highly valued. So you can't necessarily hide in software because if this market sells off hard, what normally happens is they go after the growth companies first. The growth companies get hit very hard, companies with high multiples. So you don't want, in my opinion, like I'm not going to put on 10 software companies because that could hurt badly if that group gets unwound. But I want to have some exposure, like it's a group that I think could fare better in this environment. So again, not I don't want to load up on five of these names, but maybe having two or three might make sense. And I'll go through those names in the next video. Let's just go through a couple other charts. I want to go through the sectors. I do that almost in every weekend video. XLY, remember, big component in Amazon in this ETF. So that's a little bit difficult to focus on this ETF because it's so skewed by Amazon. But it's holding the 50-day moving average. Let's just take it for what it is. Tech. Looks a little bit vulnerable to me because it's held up so well. Usually what happens in pullbacks is one of the last groups that gets hits, or what last groups that gets hit is the market generals. So I view tech as some of the market generals. They've been holding up very well. I think if they come into the 50-day moving average, you also have this VPOC down here. I think it's just too soon yet to kind of see where this goes to. XLI Industrials, a bit weaker, breaking the 50-day moving average. XLB Materials, notice it's taken out of VPOC, but you can see the picture here is weaker. XLF Financials also I think looks vulnerable here to a further pullback. It's going to be opening for certain. Looks like it's going to be opening up below value. I think financials have just been harder in general, so that's not a group that I really want to jump into right now. The healthcare group has gotten hit also on political stuff, so it's not a safe haven right now. I think in the market. So again, this also looks like it's fully broken below the 50-day moving average. That looks suspect to me. Tech, we already went over. Consumer staples. I did go into Procter & Gamble on Friday. That trade did not work, so I'll have to keep an eye on that. I was thinking a bit more defensively, but as you can see, basically everything got hit on Friday. Almost everything, I should say. This is holding up a little bit better, but still a very ugly looking candle. Utilities have clearly been on a run. So they are showing relative strength, and I think they're showing the fear. Would I buy up here the utilities just because they're showing this relative strength? Probably not. They're really overbought. The RSI is an 80. I don't like to be buying things when they're so overbought like that, just like I don't like to be selling when things are oversold. REITs, another one. REITs showing some relative strength as well, even though they got hit on Friday. They're just barely below the 20-day moving average. Energy, which is the weakest, fully breaking down here. We've talked about this many times. I don't like to really be playing in things that are so in downtrends like this. Failed again at the 200-day moving average, and it's basically been straight down. I think I covered all the sectors. Also, a couple other things, things that we've already talked about. Copper has been flashing a warning sign. Would I be shorting copper down here? No, because it's oversold. It's a 19 RSI. Would I be thinking to go long copper? I mean, no, because I think this kind of came up in the trading room on Friday. I think copper is due for a short-term bounce, but that doesn't mean like I want to really play around with that, because I think that this can continue to go down. But I don't want to be shorting things. Let's think logically. It's a 19 RSI. If you're looking to short this thing now versus when the opportunity was here, I just don't think there's as, again, you have to think about things risk to reward. Is the reward the same from when it was here? Now at a 19 RSI? No. Also, the Baltic Dry Index, that's something that I've talked about in the last couple videos. Maybe not last week, but the week before. That is also confirming that things are not looking good. Right? And if I draw this as a line, all right, so that should also be telling you, watch your positioning right now, just like with copper. To me, it is not the place yet to be overexposed, right? So as I mentioned, so I'll sum this up for you guys. Be patient, know your time frame. I like to wait for confirmation, but we'll take a few small shots. But I am going to be keeping my exposure light. That I got out of a lot of, like, if you look at the position sheet that I sent out on Friday, I'm holding mostly stock, only 2 option positions that have any significance to them. Also in the Tribeca Trade Group portfolio, where I'm in Slack, if you go to the trades, but TTG portfolio, you could go through, you could see that I've reduced my exposure a couple weeks ago, right? By 30, I have 35% cash position. In hindsight, maybe I should have gone a little bit more into cash, but it is what it is. I think I've made the right moves in this thing so far. All in all, like, nobody's perfect. And then what I'll be looking for this week is some of those opportunities that I think, where I want to go into some quality names. But again, this is a different style portfolio, so I would really be looking for that confirmation first. All right, guys, so that is it for this first video, and I'll put out a next shorter video just looking at some of the quality names that I'll be looking at for this week. Thanks, guys, for watching.